Hi guys, so here Ranmori here, co-founder of SublimeTrading.io. Welcome back to our YouTube channel. Now, a few days ago, I put up a poll in our Facebook community asking members a very specific question, which is, what is the very first step to defining an edge? What is the very first step to defining an edge? If you're not already in our Facebook group, guys, I'm going to put a link below this video. Do come through so that you can get involved real time in the discussions that take place day to day. This is our free Facebook community called the Launchpad. Now, what is an edge? An edge is ultimately the ability to define environments in the market where you have more chance of making a profit than a loss. Ultimately, what you're looking for are high probability environments. Remember, guys, what is the goal? The goal is to make as much wealth as possible, as safely as possible between now and retirement, moving with stealth, with accuracy, and with calmness. And so having an edge is essential if you want to have a portfolio that performs consistently well. It means having a plan of action. It means ultimately being on top of what is financial literacy for us as everyday people. So having an edge as an investor is essential. You simply cannot approach the markets without understanding how to establish high probability environments. There are no guarantees in investing. It's all based on probability. So you want to have the edge in your favor. Now, if you cannot define your edge, you do not have one. And if you do not have an edge, you will get eaten by someone who does. I'm going to say that again. If you cannot define your edge, you do not have one. And if you don't have an edge, you will get eaten by someone who does. So it's essential as an investor that you do have an edge. Now, there's stats out there that suggest that 80%, 90% of everyday people generally go on to lose large sums of money. Now, and that's simply because they don't have an edge. Usually they're gambling. Their decisions are based on emotions, anger, greed, fear, hope. They all play a part. FOMO often plays a part, fear of missing out. And often people choose to go down the route of day trading, which is a huge mistake. Now, quack educators and these scam promises and schemes out there of getting rich quick often paint a picture that day trading is the way forward. It isn't, because there's simply no edge in day trading and sitting in front of the screen all day long. So you cannot abandon the principles of good investing, which is to think long term. You want to be able to hold your positions for weeks, months, even years, because that is ultimately where you do less, take fewer positions, but hold your positions so that you allow them to grow. But not only do you, by holding your positions, do you grow your account, but you also give yourself the opportunity to compound. And compounding is ultimately the real secret to making substantial growth in the market. Now, it's not a very well kept secret. Everyone's heard of compounding, but it's very, very poorly practiced. To really have compounding work in your favor, you've got to have a predetermined edge, a proven edge that will, over the long term, return you more profit than a loss. And then once you start making profit, you can then start accelerating the profit phase by compounding. So it's not uncommon for us here at Sublime Trading to hold positions for 12 to 24 months. Currencies, 9 to 12 months is not uncommon. Stocks and commodities, 12 to 24 months is not uncommon before we potentially exit our positions or even rebalance our portfolio. So thinking medium to long term is essential, because that's really where the growth is achieved. So having said that, going back to the question that I put up in the community, what is the very first step to defining an edge? What is the very first step to defining an edge? Now, there were a number of different answers that were given up as part of the poll, which was great. It stimulated conversation. But as I already mentioned, there is a very specific answer. So to be able to answer this, we first need to identify that there are two stages to putting a portfolio together. The first stage is ultimately the ability to choose high probability assets in current market conditions. Remember, there are ultimately three, maybe four, depending how you look at it, main markets. You've got UK stocks, US stocks, you've got commodities, you've got currencies, and then of course you've got the cryptocurrency market as well. So you cannot ignore cryptocurrencies, but cryptocurrencies should really play a very small part of your portfolio. You don't want to put all your eggs in one basket, which is generally the mistake that people make today. You know, crypto is the word on everyone's mouth, but you want to put some money in cryptos, no doubt. You don't want to ignore it, but the vast bulk of your wealth should really be put in proven assets, and stocks is really where you want to have the majority of your money, because they perform consistently well and there are just so many good opportunities. So to go back to that, what I was saying, stage one is the ability to choose high probability assets in current market conditions. So whichever market is in trend, whether that's in stocks, commodities, or currencies, you want to be able to pick out the best assets that are performing well in that asset class. And ultimately what we're looking for are the start of long-term trends. These are sustained moves either to the upside, which is a bull market, or to the downside, which is a bear market. So of course, in today's day and age, we have accounts that allow us to go long and allow us to go short. So we go long in a bull market, short in a bear market. So what we want is the ability to choose the best assets that are either going to trend to the upside or to the downside, and ideally at the very start of trends. So when an asset has been going sideways for a long period of time and then it breaks out, that is the start of a potential trend. And that's really where you want to get into. You don't want to get into an asset that's been trending for 3, 4, 5, 6 months, because the market could potentially reverse, or the market could consolidate and your money could get tied up in an asset with no growth for a lengthy period of time. So we really want to try and catch the start of a trend right at the base, which is potentially a breakout from an area of consolidation. So that's step one, the ability to choose high probability assets. Step two is then extracting profits safely for the lifetime of a trend. And that's where a strategy or a system comes in. So first of all, you've got to be able to choose the asset based on what your analysis will be telling you. And for us as everyday people, technical analysis is simply a far more complete approach than fundamental analysis. Now, fundamental analysis works, it's just difficult, it's time consuming. Technical analysis is far simple, takes far less time, and because you're looking at charts, it can be easily adapted around your busy lifestyle. So remember, guys, you're busy, you're maybe married, kids, you've got businesses, you're maybe employed, you work a 9 to 5, you may be a business owner. Ultimately, time is short. You have hobbies, you have pets. What you want is an investment style that can be adapted around your lifestyle without compromising on time and profit. So that's where technical analysis really comes into its own. If you're looking at the right time frames, the best time frames to look at are the monthly, the weekly, and the daily, because that's ultimately where you do less and make more, because you catch the bigger moves in the market. The mistake that a lot of people make is they go down to the lower time frame. So that's the 5-minute time frame, the 1 hour time frame, whatever the case may be, an intraday time frame, and that's where a lot of money is lost. So what we want is to be able to pick good assets looking at the higher time frames. And then, as already mentioned, that's stage one. Stage two is then having a strategy that can extract profit for the lifetime that the asset is in trend. So as long as the asset is moving up, whether that's for weeks or months, we want to be consistently and safely extracting profit for as long as the asset is in trend. So we want to get in early using a system or a strategy, and then we want to exit when the trend ends, which could be 12 months, 24 months later. We certainly don't want to get out earlier if the asset is still trending. And that's a mistake as well that a lot of people make. They may get in to a market on the right side of the market, but then they exit too early because there's that fear of losing profit. You want to get in, you want to hold, and you want to compound. So when people talk about their edge being in risk management, their edge being in exit management, their edge being in compounding, for example, that's not really the very first step of being able to define an edge. That's a part of your process, which overall should have an edge. But ultimately, that's in stage two, which is extracting profit. Risk management is about extracting profit. Stop loss placement is about reducing losses. Exit management is about locking in profit. Compounding is about accelerating the profit. So that's all in stage two. And it's not really the very first step to defining an edge. The very first step to defining an edge is having good technical analysis skills. It's the ability to look at charts, particularly the monthly, the weekly, and the daily time frame, and to pick out the best assets simply by looking at the charts. The way to look at this, guys, is if I gave you 4 charts, a UK stock, a US stock, a commodity, and a currency, and I hid the ticker symbol, so you had no idea what asset they were and what asset class they were from, you want to be able to look at those 4 charts and pick out the one asset that is most likely to return you a profit, the asset that has the highest chance of returning you a profit. And remember, it doesn't matter where the profit comes from, whether it comes from a currency or whether it comes from a stock or a commodity. Ultimately, what you want to be able to do is make profit consistently and safely for the lifetime that the asset is in trend. And what you want is to be able to choose assets that have the highest chance of returning you a profit as efficiently as possible. You don't want to get into an asset and hold it for 5 years with no growth. And that's a wrong mindset as well. Often people will get into an asset and say, I'm just going to hold this for 10 years. The asset may do nothing for 9 years, and then the final year, there may be some growth. Whereas that risk that you've got tied up in the asset that you're just holding for 10 years, you could recycle that again and again and again between trending assets that are performing really, really well for 12 months, 24 months. Take your profit, move to another asset for another 12 months, 24 months, and cycle again and again and again. And that's how you will achieve consistent growth for a portfolio that's performing well when you have the ability to choose these assets with good technical analysis skills. So to summarize, guys, the very first step to being able to define an edge is having good technical analysis skills. That means looking at charts and being able to establish high probability environments where you have more chance of making a profit than a loss. And that means having a proven edge. And as a summary, guys, remember, if you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. Okay, guys, as a reminder, there's a link below this video to our free Facebook group, the Launchpad Academy. Click through, come through, and get involved in the discussions that take place day to day. And don't forget to hit the subscribe button. And of course, guys, don't be greedy. Share this information out to anyone else who you feel would benefit from this information. See you on the next video.